Hello everyone. We are now starting on with the new topic, that is your reading number 7 of market risk. Clear? Now it is about the back testing of the war model. This is about the back testing of war models. Okay. Now we are going to cover the topics in 4 parts. Okay, let us first of all see what we are going to study in the topic before we go ahead. Okay, point number 1, that is accidents based approach. Accidents based approach. Accidents based approach. Write down. Second, probability integral transform. Probability integral transform, PIT. Probability integral transform. Then distribution of PIT. Distribution of PIT. Distribution of PIT. And the fourth point is evaluating the PIT distribution. Evaluating PIT distribution. So you can see that the whole topic revolves around the PIT, then PIT distribution, and then you will evaluate the PIT distribution. Clear? So means once we are done with the first LOS, the whole 3 LOS are important and interlinked to each other. Clear? Now, if you look at the LOS, okay, the point is very clear that we just have to understand the topics. Okay, no mathematical calculation is there, because if you look at the LOS, it's all about explain, describe. That means no mathematical stuff will come in the exam. Okay, so we have to be prepared accordingly, that we understand that what they trying to convey to us. Clear? So let us begin our concepts, starting with the first one, that is your accidents based approach, or you can say accidents based back testing. Clear? And this is one of the most common method to check if a value at risk, means war model, is accurate or not. Clear? Now this is a very important concept if you'll ask me from the risk management perspective. Why? Because it helps us to determine if a bank's risk estimates are reliable or not. Back testing is very important. Clear? From everyone's perspective, for all the banks, for all the financial institutions, as well as the regulatory bodies. Now, so what is the point which we need to understand over here? First of all, this how this approach actually works. Okay, the 3 key properties of a good war model, that also we need to cover. Clear? Now, how we check if a model is too conservative or too risky? Means if it is too conservative, means it's saying that your risk is too huge, but in reality the risk is less. But because it says you have huge risk, you have to capital good amount, you have to save good amount of capital, so that is a loss to the organization, because a lots of capital is underused. Otherwise you could have put it into investments. Clear? Or too risky, means your real risk is only $100. Real risk is $100, but your system says risk is only $40. You are keeping less capital, and if anything goes wrong, your company will collapse. Clear? So it's very important to find out a balance between the conservative and being too risky, and the most important, the independence of this model, so that it will not impact the evaluation of the model. Clear? Now the first point, how this works. So before that, let us understand that what this accidents based backtesting is. Clear? Write down. It's a place or it's a method. Basically write down, it's a method where we count it's a method where we count how many times actual losses exceed the war estimate. How many times actual losses exceeds the war estimate means you says that 1% war. Okay, that means if you are using 100 days data, then your loss should exceed only for 1 out of 100 days. Clear? But if suppose let's say I'll come up with an example. Write down. I think that will be much easier for you to relate, okay, rather than this 1% stuff. Now suppose a bank uses a 95% war model. Okay, now what does this means? This means that bank should experience losses greater than the war threshold 5% of the time. Means if your trading is of 100 days, if your trading is 100 days, then out of 100 days only 5 days your losses can exceed the given threshold. Means suppose your threshold is $600 loss. So out of 100 days only 5 days are there where losses are greater than $600 only for 5 days. Clear? This is the limit. Clear? But if this exceeds, then what will happen? And if this does not exceeds, then what will happen? Clear? Now definitely you will not get exactly 5. So what if out of 100 days threshold is breached only 1 or 2 times? Suppose 1 or 2 time only. Threshold is breached only 1 or 2 times. Now what does this means? This means that there are very few accidents. Write down. Very few accidents. Now this means that the model is too conservative. Now why I am saying this, the model is too conservative? Try to understand that you have kept a threshold of $700. Okay, that's the threshold. Means if losses will increase or go above the $700, then only it will be counted as a accidents. Clear? So out of 100 days only it happens twice. That your losses are say $740 and say $720. Rest 98 days your losses are less than, or you can say your returns are less than $700. Clear? That means you have not exceeded the threshold. Are you clear? Hopefully you are understanding this point. Now why I am saying too conservative? The reason is that the threshold which I have kept, it's way too high. The reason it did not breached because it's way too high. Means if I would have kept a threshold at $600, then there would have been chances that I would have exceeded this say 18 times. Are you getting my point? So if there are too many accidents, you see, the model is underestimating the risk. Means the bank is exposed to unexpected losses because you have kept your war at $600 for 5%. So you will keep the capital for this. You are presuming that my losses will not exceed $600 for 95% of the time, but for 5% of the time losses can exceed $600. But in reality losses are exceeding $600 18% of the time. 18% of the time. That means the loss, the capital which you have reserved, it's less. The capital which you have reserved, it's very less. Clear? And hence there is a chances that you can collapse. Why? Because you are exposed to unexpected risk. You are expecting the risk only 5% of the time, but you are exposed to 18%. So there is a chances that you will experience unexpected losses. So it's, you need to be wise enough to put that where should be my threshold, clear? Now if you'll ask me, write down point number 2, three key properties three key properties of a good war model. Three key properties of a good war model. Now you want your model to be reliable, okay? And in which situation your model will be considered reliable? Point number 1, unconditional coverage. Now when I say unconditional coverage, okay, what does this means? This means that the total number of accidents is reasonable based on the expected probability. Means you are saying that 5% is my war limit, so the number of accidents should not be greater than 5. Okay, it can be within the range of say 4 to 6, but should not be like 8, 10, 12 or 14. Clear? So we don't care about the accidents. Okay, we just count how many times it's actually occurring. Clear? Let us take one example. Let us assume that you have a 95% war model. You have a 95% war model. Okay, and you are using 1 year time period, which includes 252 trading days. Clear? Now if you'll ask me what is the expected accidents, the expected accidents is 252 5%, that is 12.6. okay, now if we observe that accidents is less than 6, means I'm putting up a timeline over here, 12.6, and let us put over 6 and 20. So if accidents are less than 6, that means model is too conservative. Model is too conservative over here, too conservative. But if model is giving you accidents more than 20, that means it's too aggressive, and underestimate the risk, Clear? Now how we will check this unconditional coverage? Basically we will use the log likelihood ratio test. Log likelihood ratio test, LR test. Okay, we will use LR test. Now write down, if your LR statistic is too high, okay, means greater than 3.84, for 95% war, the model might not be well calibrated. Means your model is not well operating, or you can say the model is not well designed. Clear? So this is the first condition that needs to be met if you want a war model to be good, that is unconditional coverage. And for that your LR test should be less than 3.84. Clear? If it is way too high, that means the model is not well calibrated. Clear? Now coming to the second point, it is independence of exceedance. Write down independence of exceedance. Independence of exceedance. Now basically this particular method, what it does actually, it actually check if accidents are randomly spread over time or if they happen in cluster. Means you are saying that 5 days you will experience losses, so are they happening in a given time period, or suppose you are calculating it for the whole 1 year? Okay, so there is a chance na that one will happen in January, one happen in March, another in November, another in December, and somewhere in between over here. But what if all are happening in the month of August? What if all are happening in the month of August? Clear? This is something which we need to understand. Clear? Now imagine if this is happening in a cluster. Okay, then the business can collapse. Try to understand that all cluster are happening one after the another. That means one day you lose 600, then 700, then 800, 900. That means in this period you will lose almost all your wealth, because say you have invested $100. Clear? What if you will lose 10% one day, then another 10% next day, another 10% very next day, then another 10%, and then 10%, and then you will start making the profit. So try to understand that you will lose half of your wealth if it is clustered. Clear? Write down if accidents are clustered. If accidents are clustered means many accidents happen in a row. Comma, the model might not be adjusting to changing market condition. Suppose in a 100-day period, a 95% war model. Suppose in a 100-day period, write down, suppose in a 100-day period, a 95% war model predicts 5 accidents. Now, if they happen randomly, don't write, if they happen randomly, like one is happening on day 8, then 24, then 50, then 72, then 90, model is accurate. But if they are happening like this, day 85, day 86, day 87, 88, and 89, then this suggests that the model fails to adapt the market stress. Clear? Now just like we can check the unconditional coverage with the LR test, how you will check whether it is independence of accidents or not? Clear? So for this we will use the Markov chain approach. Write down, for this we will use Markov chain approach. Write down, it tests whether the probability of an accidents today depends on whether an accidents happened yesterday. Means it try to understand that accidents is interdependent on the previous day or not, or whether it is random. If it is dependent, then the accidents is possible that you will breach tomorrow as well. Clear? Now if your war model accidents are independent, then your model is well calibrated. But if accidents is dependent on the previous accidents, the model definitely needs the improvement. Clear? Are you clear? Now for this also we can use the LR test. If the value is greater than 3.84%, this also suggests that accidents are not independent. Clear? Now over here we have seen unconditional coverage. Now we will see conditional coverage. Conditional coverage. Conditional coverage. Now write down for conditional coverage. It combines both unconditional coverage as well as independence. It combines both. It combines both unconditional as well as independence. Clear? Next point. A war model must predict the correct number of accidents. A war model must predict the correct number of accidents and ensure they are randomly distributed. Must predict the correct number of accidents, and see, the word is and, means both are important. First of all, number of accidents should also be correct, and second, they should be randomly distributed over time. Clear? That means if I test a 95% war model on 252 days, if total accidents is 12, which is close to 12.6, this is expected and this is your actual number. This means that your unconditional coverage is met and they are spread randomly. That means independence is also good. Clear? If both are met, we call this as a conditional coverage and your model is reliable. Clear? Now if suppose we'll use LR test on a model and the value comes as say 5.99, in this situation the model will become unreliable. In this situation the model will become unreliable. Clear? So in this LOS, this is the important part, that is the 3 key properties of a good war model. Now see, in order to validate a war model, okay, based on the number of accidents, okay, that is your first point. So we are conducting LR test, that is correct, but the main point is we are conducting an hypothesis testing. Hypothesis testing. Clear? Now in hypothesis testing we need two values, test statistics and critical. Clear? Test statistic and critical value. Clear? Now first of all we need to compute the test statistics, and then I need to compare it with the critical value. Clear? Now from where you are getting this test statistics? Now that is your LR test, log likelihood ratio test. Clear? And from where you will get the critical value? This is your chi-square distribution. This is your chi-squared distribution. Chi-square distribution. Clear? And you need degree of freedom. Clear? From where you will get the degree of freedom? 95% confidence interval will tell you about the degree of freedom, and that is equivalent to 3.84. This is equivalent to 3.84. Clear? Okay, so let us keep this much in this lecture. We have covered our LOS A, and in the next lecture we will start with the LOS B. Okay, thank you.